Awesome. Super excited about this. Boom. This is great. You know, I love Tuesday at lunchtime because we get to talk about some of my favorite stuff. Hey, where do you go when your business needs money? The bank? No, folks. Here's the problem. Per the Bureau of Labor and Statistics, more than half of businesses fail within 5 years or less. You know why? That's because 82% of business failures are due to lack of cash flow. So unfortunately, 90% of business loan requests are denied by the bank, or you could say they're denied unless you give a personal guarantee. But how do we move away from that? Well, we need to learn to think outside the bank, right? That's what today's about, right? This is exciting. It's time to think outside the bank and get the cash we need to fund and grow our business. Now, I'm your host, Joseph Smith, and we're going to just jump right in. See, over the last few weeks, we've been talking about different types of lending that's available to us out there. I'm going to go ahead and share my screen. Now, what we really focus on here with this type of think outside the bank that we do at lunchtime is, here's what we want. We want to help people learn how to get the funding that they need. And funding that you need is usually based off of your cash flow, your credit, and your collateral. Sometimes we call it the 4 C's of lending. You know, like 4 C's, wait a minute, you just said 3 things. Cash flow, that's 1, credit, and then that breaks down into your personal credit and your business credit. So there's 2 right there, right? And then your what type of collateral your business owns. So I'm so grateful to be here with you. I want to give a shout out to a lot of our folks that are here. So if you're on the webinar or you're attending live on YouTube, go ahead and name your business and what state you're from, and we'll give a shout out to all those that are listening online, because we really do care about your business and your business's success. I mean, that's why we're here. So getting back to the 4 C's of lending, we're talking about cash flow, credit, both personal and business, as well as collateral. And so how do you get funding for your business without giving the personal guarantee? Well, really, the bank or the lender, it just depends who we're talking about. The lender needs some way to offset their risk. And how do they do that? Well, they can ask for some type of collateral, usually in the form of many things. Your cash flow can be collateralized, purchase orders. We really like to go over in this time many different ways to get funded. But so the last time I spoke, I talked about what are called merchant cash advances. It's a revenue-based type of lending. And what you see on your screen are the qualifications. And when you look at the factor there, like you're like, what's that on your screen? That's your interest rate, but it's really calculated on a daily factor, daily payments. This is expensive money, but look at the credit requirements, right? A 500 credit score is all you need. So there are people who don't really want to intermix their personal credit with their business credit. This is a great option for them. There are some people that would like to give a personal guarantee, but they can't. So a merchant cash advance is really what's the best option to them. So we covered this last time we spoke. That really, when you talk about revenue-based lending, that's where we just look at either just the cash flow of your business. And so we don't really care too much about your credit or collateral. We're just looking at your cash flow. And then, but cash flow or revenue-based type of lending breaks down into 3 tiers. So we covered the first tier, right? And so it's expensive to start off with. I mean, you can see it on your screen. It works out to a lot of money. But one of the things we talked about, it's a great way to get your foot in the door. And that's what's key is the more you use revenue-based lending, the cheaper it gets the next time. In fact, this might be set out for a 3, maybe a 6-month term, maybe even as much as 12. But usually what happens is if you're making all your payments every day for the first 2 or 3 months, they want to renew or, kind of like refinance the loan. They want to offer you better terms. Maybe instead of daily payments, they'll spread it out to weekly payments or monthly. You really have to know what you're doing when you go for a merchant cash advance, this tier 1 lending, because it's really, you just don't want to take this to go pay some bills. You need to use this type of money because it's expensive money. You need to use it to help grow your cash flow. This might be a huge marketing blitz effort that you're trying to push through, or maybe you needed to fix a vehicle because you have a logistics company and one of your vehicles is down. And it needs a major repair, or you needed to add a vehicle to your fleet. You get a merchant cash advance, which is usually equal to about 1 month's worth of your gross revenue. I like merchant cash advances because they're very accessible, and we help a lot of people get into these. But the goal is to not stay here. The goal is to improve your financial position so that you can qualify for some of the other cash revenue-based lending. So if the revenue coming in to your business is consistently, we want to say right around 10,000, it could be a little less, but we're shooting for 10,000 consistently, then what we want to see, what the lenders want to see is that you have the ability to pay back the money that they're lending. So the interest rates and the term help them gauge how much you can pay back. So with revenue, with a revenue cash advance, this is a great option for people who don't have the credit scores that they need. So are you able to see my screen? Oh, folks, I did not know that you couldn't see my screen. That let me see why. It's because I didn't share my screen. Sorry about that, folks. Here we go.
I was like sitting here watching for a second. Are we supposed to be seeing what you're looking at?
I just get so excited to start talking about merchant cash advances, revenue-based lending, and you're just looking at me and you're like, "What's going on?" I want you to have this information, and also keep in mind that this information is always in flux. So as I'm sharing with you the underwriting guidelines to qualify, that's today, right? These guidelines could change as far as next month, but I want to give you an idea of what you're looking for. So revenue-based lending breaks down into 3 tiers, and we covered this, what you see on your screen last time we spoke, of how do you qualify for a merchant cash advance. These are great. They're easy to get because they don't require anything more than your bank statements, right? And an application. You're going to see that that they understand that businesses might have some NSF, non-sufficient fund fees, but as long as they're low, as long as you keep that low, as long as you have multiple deposits coming in and your average daily balance is, this is all that they look at. They're looking at all the strength of your business. How much gross revenue is coming in? How many different deposits are there? What's your average balance? How many NSFs does your account have? And then what they're going to do is they're going to, based off of what they see, that's how they're going to base the daily payment on. Daily payment, yeah. Keep in mind that merchant cash advances can be expensive, and they do have daily paybacks. Usually the way that the payback is done is it's just done by an auto draft. So you don't have to make the payment, it's just automatically done. So this is a great option for a business that's low on cash flow. Maybe, like I said, you're ready to expand and you need to push a marketing blitz out there, or I was saying you needed to maybe fix a vehicle or add a vehicle to your fleet. This is And the more you use this, the better terms you get, because the more you establish yourself, any lender that's out there, they want to continue to entice you to continue to borrow their money. So they're going to give you better terms or more favorable terms the more that you show the capacity to pay them back. So, and all of these things are what they were looking for. This was tier one. So let's go into tier two. Tier two would be, we're going to start looking at a merchant line of credit based off of your cash flow. And then tier three is a term loan based off of your cash flow. So we got a line of credit or a loan. Now, to get to a tier two or tier three status, we have to be bringing in more revenue. Which one thing that was great about tier one was we only needed about $10,000 approximately coming in for monthly cash flow. And you didn't have to be in business for anything more than 6 months. Now, when we start get to tier two, we need to be in business for more than 6 months. It says on your screen there that the monthly revenue they're looking for is $25,000 a month. That fluctuates. I mean, there's some lenders that will go as far down as if you're bringing in 20,000 a month. But this is great. If you, as you grow your business, we want to move you into more favorable types of financial products. So the merchant cash advance, very high interest rate, very short term, and a very small amount of money. I mean, you're borrowing like $5,000, $10,000, $15,000, and for a very short period of time. With the line of credit, it's going to be based off of what your monthly revenue is. So if you're bringing in $20,000 consistently, right, your bank statements show your gross revenue is consistently at 20 or 25, then that's what you're going to be able to get access to, is about 20, whatever your monthly revenue is. Now, some people are like, I need a line of credit larger than that. That's fine. One of the great things about merchant lines of credit based off of your revenue is that the more you use it, right, and pay it back, you can grow your lines of credit as your finances improve. So let's say you use a line of credit and you are able to show, look, over the last 3 months, my income, my monthly revenue has increased now to 30 or to 40,000 a month. Well, you can get your line of credit to expand based off of the revenue that you're seeing. Again, so there is once you get to these tier two, tier three, it's not just based off of your revenue. Now we're looking at also your personal credit. These type of lending products have to be personally guaranteed. And you might be saying, well, I'm looking for ways to get credit without a personal guarantee. There are ways to build your business credit, gain access to credit cards and lines of credit that just focus on your business credit. And those are things, especially we're going to talk a lot about those type of options on Thursday. But when we're looking about, if you need money fast, if you need money now, it's typically always going to have to be personally guaranteed. And then anytime you're going to borrow money over, say, $150,000, maybe 250,000, anytime you are borrowing a large amount of money, the lender is always going to want a personal guarantee. But here's the difference between personal guarantee to qualify for the loan and needing a personal guarantee as just part of the requirements. If you have no business credit, then you have to use your personal credit to qualify for the loan. If you have business credit, you can use business credit to qualify for a loan or a line of credit, but then so your personal credit wasn't an issue, wasn't a factor in qualifying. But then to give them some extra collateral, they might want to, maybe it's your house or a vehicle, or they want a personal guarantee based off of your credit if it's going to be unsecured. So those are the different types of things that the lender's looking at, but it's always going to be based off of the dollar amount that you're borrowing. So some people like, well, if I borrow smaller amounts of money more often, then I won't need the personal guarantee. That's one way to look at it. So when we get to tier two, revenue-based lending, we're looking at lines of credit. And well, here's what's great about a line of credit. Of course, it's a simple interest rate, and it's going to be based off of 1 month's gross revenue. They're still going to look at at your bank, how many total deposits, your average daily balance. They're going to be looking at what how many NSFs you have, right? They want to see good bank management, and they understand that you will maybe sometimes have NSF. That's not going to actually hurt you if you don't have more than 2 in a month, or you don't have more than 5 over a 2-month period of time total. That's understandable, because you're looking. Reason why people need merchant line of credit based off of the revenue is because that there are shortfalls. Payroll comes up, different bills have to be paid, and they're due at certain times, but the money for, say, a contract or an invoice doesn't get paid till later in the month. So it's understandable why there are sometimes these shortfalls. So as long as it doesn't happen that often, lenders are okay. So with tier 1 revenue-based lending, your credit score could be as low as 500 and you could still qualify. But when we start moving up to tier 2, they would want to see your credit score at a minimum of 620. And again, but you're really not using your credit score to qualify here. It's really based off of your monthly revenue. The reason why the personal guarantee is here is because the lender is looking for a safety net. If for some reason your business can't pay, they want the ability to get the money from you personally. So this is a great option. When you're looking for a line of credit, it's typically because you don't need money right now, but you're anticipating that there are those different places where you have drop off or fall off in your cash flow. Payroll comes up, or maybe you're a seasonal based business and you know that there's some slow times. You've calculated 1 or 2 months is the slow season for you. We were talking last time about ski rental business or something like that, right? So we have to look at seasonal businesses. Line of credit is really good for them. When you look for a line of credit, it's really important to know what you're going to use it for and why, right? Because this is really critical, because when we look at tier 3, why would we go for a loan versus a line of credit? Well, we would go for a term-based loan based off of our revenue if we needed to borrow as much money as possible for the longest period of time. And so when we get to this point, we're still looking at $20,000-$25,000, coming in gross revenue. But what a big difference is when you borrow money through a basic term loan, you're going to get 1.5 times your monthly revenue. So if $20,000 is what's coming in consistently every month, you could get a $30,000 loan. And the great thing about a loan is they're even easier to pay back, because they can give you terms 6, 12 months, even 36-month terms are available. But I mean, to qualify for a longer term means you have stronger financials. You've been in business for a while. You have maybe your credit scores in the 700s. You have so you're just looking at those bank records. Maybe you have no NSFs. Perhaps you have multiple deposits, right? So the prettier the picture that you paint for the lender, the more favorable terms you get, because it's all based off of risk. And so if you can show that you are less risk, then you get better terms. So why would somebody go into a basic term loan based off of your revenue? It's because maybe you need to expand right now. You're looking to, maybe you have this office and you want to buy the office next door. You're looking to expand, or maybe you're going to, you're a franchise and you're getting another, you're adding to, you're expanding. This is money that's needed. You need as much money right now, maybe for a down payment, deposit, something that is going to expand the capacity of your business and immediately start generating more revenue because you're able to bring in more money. It's critical to understand when and where you would use a term loan versus a line of credit. Line of credit is great, especially if used with different strategies. You can use line of credits you can build your line of credit while at the same time helping to, say you already have some existing debt. Now, here's another thing. I bring that up because a lot of these cash advance, whether it's a revenue-based cash advance, line of credit, or loan, it is going to also be based off of what other lending products you have out there. I mean, if you have other loans that are out there, that's going to decrease the amount of money that you can borrow because you already have a certain amount of your revenue that goes towards that debt. So it's looking at kind of like your business's debt to income ratio. So the more debt that you have and the more income that needs to service that debt, then the less that you can borrow through a revenue cash advance because there isn't as much available to you. So these are things that you need to keep in mind. So if you relatively are debt free, then and you've got a lot of cash flow coming in, then going this route is really good because you want to establish your business credit. And so you want to work with different lenders that are going to report to the business credit bureaus. And you want to continue to establish your credit with these lenders because each time you use a merchant cash advance, that tier 1, or you use a line of credit, tier 2, right? Or you use a basic loan, tier 3, you are establishing your business's credibility. So a lot of people, we get them started in tier 1 because it's the easiest way to get in. There really is very minimal personal credit requirements. It's all based off of cash flow, and it's just $1,000 approximately. I mean, it could even be a little bit less than that, but as long as it's averaging around $10,000 gross revenue, you can get a merchant cash advance for about what you're making on average. So if you're making $9,000-$10,000 a month, you can get that kind of money in a merchant cash advance. That's always going to be, so there's higher interest rates and a shorter term, so you got to pay it back quicker. But you do that, and if you do it wisely and you plan that with the expansion and the marketing of your business, and you build and you grow, then you're showing your capacity to borrow money and pay it back. You're building your business's credit. You then, as you grow your income, can move into the next tier. Okay, well, you were at $10,000 a month, and now you've gotten to well, I mean, maybe it didn't happen overnight. Maybe you had to do several merchant cash advances, but you got better terms each time. So the money was cheaper to borrow each time, and the payback, they extended the term, and now you're finding that, wow, this is working. The marketing efforts are happening. We're increasing our revenue. Now you're ready to move to tier 2. So now you can use your revenue that's coming in and expand even more and more and more to the point where you're getting to the point where you can get these term loans. I mean, here's what's great is it's still a pretty low entry to get into the term loan. They're only looking for a 650 FICO score, right? A minimum, they're looking for a minimum average daily balance of $1,000 in your account. And that's for the 6-month term. Then you see the 12-month term, they want to see you bringing in $45,000 per month, right? And they want to see an average daily balance of 5,000. So you can get better and better terms. The better your business, the better your business is booming. And then when you're able to borrow this money, as long as you're using it wisely to expand and grow your business, then you're in good shape. So I really enjoyed this time with you today to really just talk about and discuss revenue-based lending. We talk about those 4 C's, right? Cash flow, credit, personal credit, business credit, and collateral. And each week we want to go over and discuss different areas where we can show you how you can gain access to these type of lending products that are out there. And if you're always only looking for money at the bank, you're going to find that there isn't much available. But if you look at secondary lenders and people that will qualify you for money based off of other criteria, well, then that's why you're here on this call, to think outside the bank. Listen, if you're looking to get approved for $150,000 or more in business credit, we want you to contact us here at the Wise Guys and Ties. Give us a call. There's our phone number. It's right on your screen, 888-524-9273. And when you call, you're going to be able to have either myself or even my business partner, Ray Fleming, give you a call right back. And we'll be able to set down a time where we can help go over what your business strengths are. Is your business strength in your cash flow, your credit, or your collateral? Well, let's take a look and let's find which lending products are best for your business, and see if we can help identify the lenders or the situation that's best for you. Maybe we can help get you a whole bunch of corporate credit cards, or maybe line of credit or a loan based off of collateralizing some property that you own, or machinery, equipment that you own, or your inventory, voices that you have, purchase orders. I mean, there's so many different ways. And so each week we're going to go over different aspects of that. And I'm excited to help open your mind to the possibilities. So I really enjoyed this time where we went over merchant cash advances, merchant lines of credit, and we went over term loans based off of your cash flow. Folks, I want to thank you so much for this time. Look, for those of you, each week we want you to come in and get in touch with us, join in this webinar. Let us know what you want, what different types of banking products you're interested in, or loan products. Let us know about your business. Give us a call. Go in on the chat. Tell us your business name, where you're from. We'll give you a shout out. You know, hey, it never hurts to get a little free publicity, right? All right, folks, I want to thank you so much for joining us today on Think Outside the Bank. And I'm your host, Joseph Smith. And on behalf of myself, Ray Fleming, the Wise Guys and Ties, we're the experts in business credit and business financing. Give us a call. Let us help you today. We're looking forward to working with you. God bless, and we'll talk to you real soon.